But which stocks should you own if the economy does start to slow as a result? Joining me now with some picks are Cliff Hodge, the Chief Investment Officer at Cornerstone Wealth, and Mark Avalon, President of Potomac Wealth Advisors. Thank you both for being here. Cliff, tell me, Visa, Adobe, Merck, why are those names that are attractive to you?
Thanks, Kelly. So we think that we are actually going to be in for an environment of both slowing growth and slowing inflation from here. And so when you get into those times where, from a rate of change perspective, growth falls, markets will actually pay up for growth. So Visa is a name to consider. The returns on capital here are phenomenal. We're talking 30+% on returns on equity, 20% returns on invested capital, with really fat 65 to 70% EBITDA or cash flow margin. Sales are forecast to grow at 20% next year. It's a cash machine. It's lagged the S&P by about 11% over the past year. So that could be one to consider on any sort of viable dips that we may be getting over the coming weeks.
Mark, are you also expecting, sort of a slowdown, or do you think the market's going to perform well? Because I see you saying in the second half of 2021, the market will need a new catalyst to match the year-to-date results, and that's why you like names like Netflix, for instance, which has been more of a laggard. Tell me about that.
Well, Netflix was severely impacted by the shutdown. It seemed at first that it was going to benefit because there were subscriber growth, but the reality is in the long term, the pipeline dried up. There's no buzz for Netflix. Tell me the last time someone told you about a new hot series they're watching on Netflix, but that's going to change in the winter. And that's going to coincide with cold and flu season. Even if we don't have a spread of this variant, people are going to be concerned about being in movie theaters with people coughing on them. And when there's buzz with new Netflix releases, I think you're going to see investors go to that stock.
All right. We also like O'Reilly, Advanced Auto Parts, AutoZone. So, definitely still a play on kind of the millennial home ownership and car purchasing plays and all of that. Tell me also about Zimmer Biomet and Callaway. And I didn't realize that Callaway bought Topgolf, but you think these are all, I sort of see where you're going here. They're sort of pandemic light plays.
They are pandemic light. They do well in the pandemic, and they're going to do well as a result of permanent change in the pandemic. That's our big theme. Is instead of trying to guess if this COVID variant is going to pressure markets too much, I want to be invested in either place. Golf is here to stay now. 10 million more rounds per month are being played. The Topgolf purchase is going to widen the pool of golfers that are out there. And when we get the supply chain issues worked out, there are months-long wait right now for golf clubs. We think the equipment sales at Callaway benefit. That's a macro trend. The other macro trend, AutoZone, plays off on these massive used car sales that we've seen, used car prices through the roof. The millennials and the burbs need two cars, and the parts manufacturers are a smart way to play them. And the action in the stocks reinforce that trend.
The millennials and the burbs need two cars. It's true. It's just funny to hear how it adds up to these investment themes. Cliff, let me turn back to you and ask what happens if the view that you guys foresee is either already priced in or off in the sense that maybe we have a growth surprise or a deep slowdown. What's the biggest risk to your stock picks, Cliff, do you think?
So the biggest risk is what everyone's already talking about. It's inflation. We think that you're going to need to see sustained wage growth at more than just the lower end of the spectrum in order for that to come to fruition. And it's not likely from here. You would also see that flow through into other asset markets. Real yields would move higher. You would see the yield curve begin to steepen out. We're just not seeing those. We're seeing the opposite. And so, as you know, once something is consensus, i.e. the inflation narrative, you're probably already late to the party.
Yeah. So final word on that, Mark, and I'm glad that Cliff mentioned real yields because they fell to a new low over the weekend of about minus 1.1%. So, how do yields and inflation play into your picks here or present a risk?
I think investors need to be patient around the inflation scare, the macro massive demographic trends of aging populations, slow growth in Europe and Japan, technological innovation, globalization, all of these suppress prices. A tax hike in 22 also will suppress inflation. I think investors need to look beyond the inflationary scare and not be too worried about it.
All right. Well, we'll leave it there for now. Thank you both.
Shepard Smith here. Thanks for watching CNBC on YouTube.